QuickBooks Online 2025. The customer cycle, which might also be called the accounts receivable cycle, the revenue cycle, the sales cycle, or the income cycle. Get ready and some coffee because we're learning how to save time with QuickBooks Online. Partially because if you're in the United States, you got to file your taxes or else you might be doing time, which means you lose a lot of time, and we're trying to save that time with QuickBooks Online 2025. We are online in our browser searching for that QuickBooks Online test drive, the free sample file available to everybody looking for the result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. We might have to then verify that we are not yet a robot because I haven't implanted those artificial intelligence implants that are going to help me with my video game playing. Just kidding. In any case, now we're in the sample company file, Craig's Design and Landscaping, opening the major financial statement reports, the process we do every time. The reports, they're on the left. We're under the standard tab in the favorites, right-clicking on that balance sheet to open a link in a new tab. Same with the P&L, the profit and loss, sometimes called the income statement. And then let's go to that tab in the middle. Close up the ham boogie. We're going to change the range to 2 years, 010124 tab, 123125 tab, so that we can select the drop down, see it by years, and run it to refreshing, having 2024 and 25 side by side. Let's go to the tab to the right, same change to the range. We're going 010124 tab, 123125 tab, dropping it down for the years and running to refreshing, noting there's nothing in 2025 except for that $34, including the transactions we've entered in prior presentations because we refreshed the screen every time, logging out of the browser, logging back in, possibly sometime using incognito windows. So if you're following along, you might want to do the same. Otherwise, you'll have the prior transactions in your system, and that might not be a problem. But let's go to the first tab here. We're going to select the plus button. We've been looking at the cycles, noting that we have the full accounting cycle we can think of on a yearly basis, breaking down possibly then to a quarterly basis, then to a monthly basis, and then within each of those time frame cycles, we have the cycles of processes, which we can break out to the customer cycle, the vendor cycle, possibly the payroll cycle. Last time, we've been thinking about the vendor cycle, which ultimately had the money going out for goods and services that we're purchasing for the goal of revenue generation. Now we're going to be in the customer cycle, which ultimately has, hopefully, money coming in for goods and services that we provide to the customers. Now note that vendors, the term vendors, oftentimes people still get a little bit confused about that because it's kind of an abstract term. We don't use it all the time in English, at least where I'm at. I don't call people vendors all the time usually, even though if they sell stuff, we might call them a vendor, but it's kind of a strange word. Whereas customers, of course, is a fairly common term. But remember that both of those depend on what side of the table we are on. Meaning if we're a business, we are still the customer of other businesses. I am the customer as a business of the telephone company because I'm purchasing their stuff. I'm purchasing possibly inventory where I am a customer. So when we say customer here, of course, we mean our customers, the people that we are selling goods and services to. So the vendor side of things, again, in normal language, we could be a vendor or we have the other person that we buy from as the vendor. For QuickBooks, it's the side of the table where we are buying from someone else, we're buying from the vendor. Whereas on the customer, we are customers in reality in general terms as well as we have customers. But for QuickBooks, we're on the side of the table of our customers being the people that we sell the goods and services to. In this case, a landscaper, we sell our landscaping services, hopefully generating revenue. Now, also note that when you're talking about money going out of the business, it's usually fairly straightforward that it's going out for the purchase of expenses in order to help us generate revenue or assets like property, plant, and equipment that will have to be accrued so that we can then consume them to generate revenue in the future, or it might be going to the owner as a distribution or a dividend if we're a corporation. On the customer side of things, ultimately, hopefully, most of the money that's coming into the business is coming from customers, from the sale of goods and services, or it might be coming from the startup costs that we could have, such as us, the owners, putting money in as an investment, or possibly from a loan so that we can get money to invest in the company from, like, the bank, for example. So we would just want to distinguish what's ultimately happening on the customer cycle. We're expecting that's what has the cash flow going up ultimately. However, we might have an accrual component in the customer side of things. So notice what we have here. We've got all these forms that could be related to the customer cycle. We're going to look at each of those forms. But first, let's think about the flow in a flowchart format and try to think about the easiest customer cycle, and then adding levels of complexity, also considering how possibly the bank feeds could fit in to each level of complexity as we go through them. And then as you're thinking about this, you want to think about your business or your business as a bookkeeper and what type of clients you want to pick up and what type of clients you maybe don't want to pick up because they don't fit into your accounting process, noting that I really think that's a key to a successful bookkeeping business. Knowing who you're actually marketing to. It's not just anybody that happens to need bookkeeping needs, because that varies greatly. That's too broad. We want to basically pick and choose where we have a competitive advantage and where we can specialize our skill set, possibly either picking up more clients and automate things, or picking up less clients and charging more because we have a more specialized set of skills in that area. All right, let's go over to our flowchart over here. This is the QuickBooks desktop homepage flowchart, and people get mad at me when I use it, but we're looking at the online stuff. This is just the flow of the forms, which is the same for any accounting system, and this is just a nice flowchart to be able to analyze the different flows of the forms here. So we're going to be on the customer side of things, which again, you could call the revenue cycle or the sales cycle because it's money coming in, or you might call it the accounts receivable cycle, because if you're in a larger business, for example, that has to deal with accounts receivable, then that's where you're going to spend all your time, right? Just trying to collect on the accounts receivable. All right, so let's first think about the easiest system. So I want to make things simple. And if we're a bookkeeper, maybe we look for businesses that we can make as easy as automated as possible, which means we want to put them on a cash basis, use the bank feeds as much as we can. Note that that's usually easier to do or more often easy to do on the vendor side of things for small businesses, because when they pay for things, we can get people to say, hey, just put the checkbook away and try to do electronic transfers, and then we can see everything. We can use the bank feeds. We can automate everything, and that's great. Note that when we're thinking about whether we can use the bank feeds to record transactions and whether we're on a cash-based basis or not, we want to think about it not for the entire company, but by cycle. So it's quite possible, in other words, that we have the vendor side of things, the money going out, paying for goods and services on a cash-based system. However, on the revenue side of things, maybe we don't, because we have a more complex system just by the industry that we're in, possibly in this case landscaping, because we have to invoice the client for the work tracking accounts receivable, which is going to mess up the whole kind of process. So we want to think about it from cycle to cycle in terms of how much are we on a cash basis and how well can we integrate the bank feeds to automate things. All right, so what would be the easiest type of business for the customer cycle to just automate the whole process? It would be something normally like gig work. You have a YouTuber client or something like that, or someone that gets paid by gig work and the platform just pays them. And not only that, it pays them directly to basically their bank account, right? That would be the easiest type of thing. And then what would happen? Well, we can see it come through on the bank feeds as a deposit. And because it was an electronic transfer, we can see who it's coming from, like Google or like whatever platform that they received it. And then we can just record it at that time, which means that even though we're using the bank feeds, it would create a deposit form. And we can apply that deposit form to the increase of revenue. So that would be the easiest kind of system. But however, note, this deposit form is not what is really designed for QuickBooks for revenue, to recording of revenue. The forms designed for recording revenue are invoices and sales receipts. The deposit is usually the next step in the process. We have the invoice and the sales receipt, and then possibly like a deposit form. And why is that important? Because we're losing some of the functionality of an invoice and a sales receipt. Meaning, if there's sales tax involved, we're gonna have problems with that if we use just a deposit form. If we want to use the full sales tax service and that's going to be a consumption type of tax. If you're in another country, you have a similar kind of issue for a consumption type of tax, and it's going to be hard to track like inventory. It's going to be hard to make something billable so that I can convert it from here or make something that was billable, add it in that way, or connect a billable item. So those kind of things, if you need those kind of things, it'll be a little bit more difficult to just integrate the bank feeds, right? Also, when we sort the different revenue, usually on the income statement here, and this is something I'm going to try to keep on reiterating, on the income statement, notice what we try to do here is we have basically a generic few accounts on the income statement, meaning I'm not going to make a separate account for every single thing that we do. In this case, every different type of landscaping job, or if I had inventory for every different product of inventory. Because this is a job cost system, there's way more income accounts than I think a lot of businesses might actually have here. The idea is that you want to have few income accounts and then possibly give you more detail about the things that you're selling, goods and services, with subledger accounts, which you can run in reports here. Those subledger accounts are going to be, again, a little bit more difficult if we're creating our bookkeeping system with just the deposit form, because the subledgers are usually generated, again, from the invoices and sales receipts. We also might be tempted to have an income account for each a person or customer. And we don't typically want to do that. We don't want to make another income account for every customer. Typically, what we can do is run a subledger report by customer, giving us that added detail so that we can have a nice, simple, clean income statement. However, if you're doing gig work or something like that, and you're getting paid by just large platforms, then it would kind of make sense to just basically put the customer in here, right? This is the YouTube platform. This is this platform. This is the other platform, which means you're kind of recording your items by customer, paying you whatever from AdSense or something like that. All right, so that's kind of the exception. Now, what if you're still on a cash-based system, but you actually are at a cash register? If you're at a cash register like a food truck or something like that, then usually you would want to integrate the sales receipt form. You don't have to, because you could say, hey, look, what I'm going to do is I'm just going to sell stuff at the food truck. Maybe I just collect cash would be the easiest thing if you could still get people to pay you in cash, right? And then at the end of the day, I go to the bank and I cash my money into the bank. And then I wait till the bank comes through with the deposit form. And then I just record the revenue with the deposit form using the bank feeds. That would be the simplest thing to do. And that could work. But you have some problems. You're losing some internal control here at the cash register, because usually what we would like to do is record the sales at the cash register as they are made, especially for hiring someone else to record the sales, so that we can tie out the sales numbers to what's in the cash drawer, right? And then we have a check about the internal controls there. And then we would like to take it and deposit it into the bank. So what we'd like to do within QuickBooks is, as we make the sale at the cash register, record the sales receipts, not recording them directly into the bank account at that point in time, but usually to a clearing account, like funds to be deposited or undeposited funds, so that I can then take that money to the bank and transfer it from undeposited funds to the checking account when I do that within the QuickBooks system. Why is that important? Because of the bank reconciliations. So in other words, if I do that, even though I'm on a cash-based system, I'm going to have to deviate from simply relying on the bank feeds. Why? Because I'm trying to do the internal control at the cash register. And then why can't I just deposit them directly into the bank when I record the sales receipt? Well, if I record like 20 sales of $5, then when I go to the bank and deposit physically the money in the bank, I'm not going to deposit with 20 separate deposit forms of $5, which means it would come through the bank account with all those separate transactions. Instead, I'm going to group them together and deposit them at one time, which means that if in my system I have in my checking account general ledger a bunch of $5 transactions, and then the bank has one transaction, when I reconcile, possibly with the help of the bank feeds, I'm going to have to match them out. I'm going to have to do this matching process, and that's going to be a pain. So what we want to do is when they come through the bank feeds, or when we do our bank reconciliations, same kind of idea. We want the amount that we put in our system to match exactly the same grouping that's on the bank, so that the reconciliation that we could help to do with the bank feeds is as easy as possible. We also have an issue if we're at a cash register that we might be selling things subject to sales tax, which is a type of consumption tax. And in that case, we'd need the register typically to generate the sales tax, meaning we can set up how the sales tax is calculated, say, hey, this is what I'm charging you. And then the system will tell us the added sales tax so we can collect the proper amount and then record it properly, record in the proper amount of sales and the proper amount of sales tax, tracking the sales tax that we can pay in the future. Now, again, you might say, hey, look, I don't want to do that. I want to make it easy. I don't want to use the sales tax widget. So you could say not do that. And you could say, if you have sales tax, you could still say, look, I'm just going to collect the cash and include the sales tax in the sales price, right? And we talked about that in a prior presentation. So you could still try to make it as easy as possible so that then you can wait till it records as a deposit and it would be recording in revenue, everything including sales tax, and then you would have to do an adjusting entry for the sales tax portion so that you can pay the proper sales tax. So you can kind of do a workaround even if you're at a cash register situation. Just depends on how complex a system that you want to put together, but oftentimes it might be a little bit more complex even if you're on a cash-based system. And then you might be in a system where you have invoices like most likely we would have here on the sale of landscaping services. So in that case, I can't choose to be in a cash-based system. Why? Because I have to track accounts receivable, and typically I want to do that within QuickBooks. So if I'm on a cash-based system, I can't track accounts receivable typically because the accounts receivable is the account for people that have not yet paid us, right? So in that case, we would have to basically do the work, then invoice the client, sending out an invoice, which is kind of like billing the client, right? And then I'd have to track the invoice, meaning I'd have to track the invoice, receive a payment from the customer, and then take that payment and record it as a deposit. Now, so you might say, well, okay, how do the bank feeds fit in there? Well, you could try to set up a system where you like make an invoice and then you wait till they pay you. Possibly you set up a payment system where they can pay you electronically or something. And then you can wait till the deposit clears the bank and then try to match the deposit that cleared the bank to the invoice. So the system will automatically record the receipt of the payment and the deposit. So that might be one automation kind of process. We'll talk more about that when we get to the bank feeds. But you might also have to just say, okay, I'm going to record the invoice and then receive the payment, basically a check in the mail or an electronic transfer that we have received. And then I'm going to record the payment. Notice when you record the receipt of payment, you could possibly put it directly into the bank account with this form. But if you have an intermediary like a credit card company that you're receiving payments from, or a PayPal or a Stripe, we have the same problem that we talked about with cash, meaning that intermediary might group the payments together and deposit it into your checking account in a different grouping than each individual sale. So once again, you're going to need this clearing account, which would be called undeposited funds or funds to be deposited, so that I can put it into that account and then get the proper grouping and possibly allocate any fees for the credit card company or the PayPals or the Stripes, so that I can then make the deposit into my checking account in the same grouping that will be going through the bank feeds, so that when the bank feeds come in to our system, it's not going to record a new transaction, but I'm just going to match the transaction out, helping us with the bank reconciliation process. So those are going to be the typical kind of inventories that we have. Now, the typical from easiest to hardest methods for the cash for the revenue cycle. We also, however, could have inventory. If we have inventory, that's going to mess things up as well, whether we're at a cash register or whether we deal with accounts receivable. Why? Because we have to track the inventory units. So how are we going to do that? Well, it depends what kind of business we're in. If we're in like a Shopify store, or if we're tracking the inventory on an Excel worksheet or something like that, then we might track the inventory externally. And that would mean that I could still possibly be on a cash-based system, meaning I actually sell inventory, but I'm only going to maybe wait till it clears the bank or just record the revenue side of the transaction when I sell the inventory. Then I'll do a physical count of the inventory and determine how much of it has been sold, allowing me to do an adjusting entry, lowering inventory, recording the cost of goods sold on a periodic system, right? So we'll talk more about that as we think about our transactions. You also might be let's think about inventory from most simple to most complex, right? What would be the most simple inventory system? Well, it would be a cash-based system. So in other words, maybe you deal with inventory, but what you do is you take on a job and then you buy something specifically for that job, and the turnaround time on the job is like 1 day to a week or maybe a month or something like that. Well, in that case, when you buy the stuff, it is basically inventory, but maybe you just record it to cost of goods sold at the point in time you buy it with a check or a bill form. And then when you record the invoice or the sales receipt, or possibly just record the deposit to the revenue account, all you have to deal with is the revenue side, just increasing the revenue. And you don't have to deal with the allocation of inventory. However, if you have to track inventory, which often is the case when you buy inventory and then track it, or you have a longer job cost system or turnaround, then you're going to have to buy the inventory and put it on the books as an asset, as we talked on the vendor side of things, which is an accrual thing to do. And you're going to have to track not only the dollar amount, which is in QuickBooks, but also the units, which might be in QuickBooks if you use a perpetual inventory system, or might be tracked elsewhere in Excel, or if you have a Shopify store or some kind of Amazon online store that you're dealing with, then you might track it there. Right? And so that would be most likely the second most easiest way to do it, is that you track the inventory outside of the QuickBooks system on a periodic inventory system, and you have the units there. And then again, you still transfer the sales over with an invoice, a sales receipt, or the deposit form, only recording the sales side. But every time you purchase something, you're increasing the inventory account in dollar amount, not tracking the units in the system, but tracking the units outside of QuickBooks. And then periodically, possibly at the end of the year, at least for tax preparation, if you're in the United States, or possibly quarterly or monthly, you do an adjusting entry based on the physical count of inventory that you still have, which would mean that you're lowering the inventory based on that count, and you're recording the related cost of goods sold. So that would be the next simplest thing to do that has less setup process. And then you could do the full inventory system within QuickBooks, meaning you're tracking it on a perpetual inventory system, which means when you buy the inventory with a bill form or a check type or expense form, you're increasing not only the dollar amount of inventory, but the subledger of units of inventory. Then when you sell the inventory, it's going to decrease the dollar amount of inventory, record the cost of goods sold, and decrease the subledger of inventory. If that's the case, you have to do the setup process for all the inventory so we can track it. And we'll talk about how to do that. So we'll do the most complex scenario so we can see the complication of the inventory. By the way, we have other courses or sections on like a Shopify store and how you might think about that process. But that means that you can't really use a deposit form to record the sale at the point in time it clears the bank, because this deposit form in QuickBooks doesn't typically deal with the recording and tracking of inventory. You have to use the sales type forms, which would be the invoice and or the sales receipts, because those are the forms that will properly reduce the inventory. And you can imagine the sales receipt, for example, being similar to if you go to a grocery store and you scan your own item. The scanner is going to tell you how much it costs and how much they're charging you, but it's also tracking internally the reduction of inventory, the cost of goods sold, and the unit reduction of inventory for the subledger. All right. Now, there's one other kind of method that we might have that's it comes up fairly often that we'll touch on, and that is, well, what if I get paid before I do the work? So remember, with most of the time, most businesses, they get paid at the same time, like a food truck or something like that, or they have to do the work first and then get paid, invoicing the client, like a CPA firm, a law firm, the landscaper here, or you might get paid first. When might that happen? So now you're going to get paid before you do the work. That's more unusual, but it's becoming more kind of common these days for certain types of industries. So the classic example is like a newspaper company. Newspapers are kind of obsolete because they've all become, all the newspaper companies have become like corrupt. You can't really trust them. It's like you're just buying a paper of lies, basically. It's like, what is the point? I don't. But anyway, so they used to get the newspaper, and when you order the newspaper, you pay for like a year's subscription, so that you're basically trying to subsidize some kid trying to get his way through, get himself some money, for spending money or whatever. But now, of course, it's some creepy dude in a van driving around throwing a newspaper at. So I wouldn't even. But in any case, you pay for advance, and then when they give you the newspaper, that's when you earn the revenue. So from a revenue recognition principle, when they pay you, you haven't really earned it. So it should be a liability at that time called unearned revenue. And then when like the creepy dude in the van throws the papers through your window, that's when they earn the revenue. And then you should decrease unearned revenue and record the revenue at that time. Now, these days, again, I wouldn't recommend, obviously, no one recommends buying the newspaper these days, unless I don't know. But you might buy like software, and software has a similar kind of subscription model. So you might get your news, somewhere that's not like totally correct. You might, and then if maybe you buy like software online and you try to get your news that way or something like that. In that case, then it's the same kind of thing. You pay for it in advance, and then as they provide you access to the software, they're gonna earn their revenue. So you have the same kind of scenario where they would want to get paid. They would want to record it as unearned revenue in advance, and then record the revenue when they earn it. You also might see a situation, for example, in rental property, where you might pay them the last month's rent in advance, so that they have that as or it could be a security deposit, which is a similar kind of example. They're getting money, but you haven't done the work. Or a concert, for example. If people are selling concert tickets, you got to pay for the concert before the concert happens. So they shouldn't be recording it as revenue from an accrual basis standpoint when they sell the ticket, because they haven't given you the concert. And if they don't give you the concert, they should give you your money back, or else it's a scam. Until the concert happens, you haven't earned the money, you just have the money. You haven't earned the money, you just have the money. You best get the concert out, you get sued. So those are the general examples. Or you might sell a big product, like we're going to do a guitar example. And if you order the guitar, then you might say, hey, look, I'm going to order you a custom guitar. I would like an advance payment so that I can order you the guitar, or any kind of long-term job system, which could lead to other revenue flow assumptions for if you're building a house or something like that. But if the job is long enough, then you might do a completed contract or a job cost system and so on. So just to touch on those, we'll touch on those ideas. And then, of course, we have the estimate form, which could be something that you do. It doesn't actually record a transaction, but we might have an estimate that we have before we do the work, right? And we can see if they want to pick up the work based on the estimate. All right, so we'll touch on those forms. So it's a general idea. So if I go back on over here to the first tab, we hit the plus button. That means I can look at each of these forms: invoice, receive payment. We have statements, estimates, sales order, credit memo, sales receipt, and then recurring payment, shipping labels. These are more abstract that might not apply all the time. Refund receipt, And then if we have a type of business where we have to track the accounts receivable in particular, we would go into what I would call the customer center. That's what it used to be called. Now it's the sales tab over here. And then we can track the customers. Now, like with the accounts payable, where we only went into like the expenses or expense or vendor center when we had to track the accounts payable, typically, unless a particular person had a question about a particular payment, here we have a similar situation. We're going to spend a lot of time in here if we're in the type of business where we have to track accounts receivable, where we do the work first and we have to collect on it, because there's a lot of deadbeats out there. They don't pay you. You send them the invoice and they don't pay it. So you have to do a lot of work sometimes, depending on who your clients are. And you might want to think about who your clients are. It might make life easier if you had clients that actually paid you without hounding them. But then you would have to spend a lot of time collecting on it here. Also, if you had advance payments, then you might end up spending a little bit more time here in those type of businesses as well. Otherwise, if you're getting paid by YouTube or gig work or something like that, or you're getting paid at a restaurant, then you're probably not going to be here all that much, because the transaction is done after it's done. And in some cases, you might still have particular questions. There might be a return of merchandise or something like that. If you sold something at a cash register, and you'd still have to go in here and say, okay, I see where you're at, and so on and so forth. But from a general standpoint, we'll be in here most often if we have to deal with that accounts receivable. Otherwise, we're going to hopefully just do our work at the cash register here, taking the form or recording the payment or revenue when it comes through the bank feeds. And then that is it. So we'll go into each of these. We'll take a look at the center over here in a little bit more detail next time. And then we'll take a look at most of these forms one by one.